What if you're a business owner and you're trying to figure out if you should use tax deferred investments? Now, these are often called really valuable investing tools, and many people are very interested in deferring taxes. But why? Have you ever stopped to think about why is deferring tax so popular? Well, a lot of times people have this misperception that if I defer tax today, I'm saving tax. Unfortunately, it's not that simple. Let's talk about what tax deferral actually means and how it can be a tricky trap for you, especially if you're a business owner. First of all, tax deferral is available through qualified plans. These are usually government-sponsored investment tools like 401ks, 403bs, and IRAs. And specifically for business owners, there's simple IRAs and SEP IRAs. There's also 457 accounts and tax-deferred annuities. Now, what is happening is that you are taking a portion of today's income and putting it into a qualified investment. Usually that's saving for retirement. And what is happening is you are then taking that as a tax deduction today. So that portion of money that you're putting into the investment is not part of your taxable income in this current year. So it can be a way to shelter a portion of your income from taxes and not have to pay tax. But that's only this year alone. What happens in the future? Well, you've put this money into a tax deferred vehicle, and now when you're in the future and you're planning to take that money out, whether you are taking it out as a withdrawal to use that money, or you're after 70 and a half and you have required minimum distributions and you now need to take money out, you will pay tax on that money at the time that you remove it from that investment vehicle. And it's not just the tax that you didn't pay in today's year, it's the growth on that money as well. Let me help you understand what this looks like. Imagine you put aside $15,000 every year for 30 years. If we take 15,000 times 30, that number is $450,000. Now let's just say that you are in a 30% tax bracket, and so you're deferring this money, the $15,000 per year, you're deferring tax on $450,000 worth of income over the span of 30 years. What is that in terms of a 30% tax bracket? That's $135,000 of tax. So do you think then that you would pay $135,000 in tax when you take that money out, or something different? Well, it's going to be more because of multiple reasons. One, you're hoping that account is going to grow. Let's just say it did grow at 6%. Your money inside that qualified plan is growing right alongside those taxes. So your money's growing and so is the tax. What that means is that say that account grows at 6% and you end up with $1.2 million in that account. Now you're going to pay the tax rate on that $1.2 million when you go to take the money out. So if you're still in a 30% tax bracket, you're going to pay $360,000 of tax. So think about this. You deferred $135,000 of tax. Now you're paying $360,000 of tax. You're actually paying more tax in the future. And the reason that happened is because your money was growing alongside the taxes inside that account. That's why it's actually more accurate to think of this as almost a profit sharing plan with the IRS. The other thing that's really important to realize is that you're not saving tax. You're actually kicking the tax can down the road. You're postponing or delaying or even procrastinating tax. So you're not failing to pay, you're not saving tax, you're just saving it this year. But when you look at the landscape of your entire financial life for your entire span of years, you actually will end up spending more in tax. Now here's the thing, with tax deferral, it actually can make sense if you defer taxes when you're in a high tax bracket and take the money out in a lower tax bracket. Now that is the primary reason why it's so popular, because there's this common assumption that you will be in a lower tax bracket in retirement. And how does that actually work? Well, you think about, maybe you're making $200,000 today and you're thinking, part of that is my savings. And so when I'm in retirement, I'm going to live on less. Maybe I'll live on $150,000 instead of $200,000. So my income is going down. Therefore, I'll be in a lower tax bracket in the future. But we really need to understand that there's also tax brackets which have a upper limit and a lower limit. And a lot of times, even if you come down in terms of income, you still are falling in the same tax bracket in the future. We also have to think about, what do we think the future of taxes will look like Will they stay exactly the same as they are today? Will the landscape stay the same? That means, will the thresholds and the tax brackets stay the same as they are today? And that is a really important question because throughout history, taxes have changed lots of times. In fact, if you look at a chart that shows the history in the United States of the top tax brackets, you'll find that today, in about the last 30 years or so, we're in a lower tax rate environment than we have been at almost any point prior to that since 1913, meaning that today's taxes are lower than most of the taxes have been in the past. In the past, we've seen an increase in tax brackets for things like wars with World War I, World War II, the Korean War, the Vietnam War. And now we've seen also in our lower tax environment, we've seen a lot of government spending in terms of more recent wars in the 21st century that we have not increased taxes to pay for yet. When we look at that along with over $22 trillion of national debt, and we look at the unfunded liabilities that are over $100 trillion of programs that the government has promised to pay but doesn't have the capital to do so yet, I look at the revenue needed in the US government in order to cover those programs, and the only place they have to draw from is taxes. I'm not confident that taxes are going to stay the same in the future. So all of that adds up to saying, if I'm a business owner and I'm planning to live this exponential life and I'm planning to grow my business exponentially and profit exponentially and increase my income, I'm not likely, first of all, to even land in a lower income situation in the future, so probably not in a lower tax bracket. And then on top of that, I'm giving up control of my capital to blindly kick the can down the road and procrastinate those taxes to a future where I might end up paying a lot more tax than today. I would rather be in a position of control. And as a business owner, I want to have access to my capital so that I can use that money to actively invest in assets that produce cash flow that I know and control. So all of those things are a recipe for me saying I don't want to put my money in a position where I'm deferring tax because I don't like the qualified plan environment that's invested in mutual funds with a volatile stock market and having limited access to my money and then having an unknown tax future. That does not make me sleep better at night. As a business owner, I want control of my financial resources so that I can control my financial future. So I hope this really helps you to think through what tax deferral means and how it could be a trap that prevents you from having access to capital that you want and need to build time and money freedom. Hey, I hope you liked this video. If you did, click the link in the description box below for more information. And don't forget to like this video. Share your comments, questions, and feedback in the comments section below. And don't forget to hit subscribe to our YouTube channel.